All right, class, let's get settled and begin. Welcome, everyone. So today, we're going to tackle a topic that's, well, it's both fundamentally important and honestly often misunderstood. We're talking about the tax implications of a taxpayer's death. I know it sounds a little grim, but trust me, for any of you who are planning on going into public practice, financial planning, or estate law, this is an area where you can provide just immense value to your clients. Okay, let's dive right in.
So here's our game plan for today. We'll kick things off with the basics, what the final return is all about. Then we'll get into the nitty-gritty of some pretty special income rules. After that, we'll tackle the biggest concept of all, deemed disposition, and its super important exception, the spousal rollover. And to wrap it all up, we'll look at what happens after the final return is filed by digging into the role of the estate.
The first and most critical point to get into your heads is this: death does not stop the Canada Revenue Agency. Nope. A final tax return, which you'll often hear called a terminal return, absolutely must be filed for the person who has passed away. This return is a snapshot, capturing all the income they earned from January 1st of the year they died right up to the very date of death. All the usual income sources are there, but as we're about to see, some very, very unique rules kick in.
Okay, so let's get right into those special rules. You see, certain types of income and deductions are treated completely differently on a final return than on any other tax return an individual will ever file in their life. Really understanding these is the key to getting this stuff right.
Now, this slide shows a really crucial change that happens at death when it comes to tax deferrals. Normally, right, if you sell a property and you don't get all the cash out front, you can claim what's called a capital gain reserve to put off paying some of that tax. Same idea for things like a reserve for bad debts in a business. Well, in the year of death, that deferral just stops. As a general rule, the full amount of any of those reserves has to be brought back into income on that final return. Now, there is an exception if the property goes to a spouse, but the default rule is pretty blunt. No more reserves.
Oh, this is a big one. This slide just perfectly illustrates one of the most common and high-stakes issues you'll face. What happens to an RSSP? And the answer depends completely on who the beneficiary is. If a spouse is the named beneficiary, the funds can roll over to them and they get taxed on the money as they take it out. They can even pop it directly into their own RSSP and just keep deferring the tax. But look over on the right. If the beneficiary is anyone else, a child, a friend, or even the estate itself, the entire fair market value of that RSSP on the date of death becomes income on the deceased's final return. This can create a truly massive and often very shocking tax bill.
Now, let's contrast that with a TFSA. The rules here are so much more favorable, it's really night and day. If a spouse is the beneficiary, the account basically just keeps its tax-free status. The value at death and any income it earns after death, it all stays completely sheltered from tax. The surviving spouse can even merge it with their own TFSA. It's just a much simpler, cleaner transfer, and it really highlights how different these two types of registered accounts are when it comes to taxes. All right, let's switch gears and move on to what is, without a doubt, the single most significant tax event triggered by death. This is the big one, folks, the deemed disposition of capital property. This is the rule that so often causes the largest tax liability for an estate. So what in the world is a deemed disposition? Well, you can think of it as a legal fiction, a pretend sale. The CRA basically says, look, the moment right before this person died, they sold everything they owned, their stocks, their rental properties, the family cottage, you name it. And they sold it all for its full fair market value. No actual sale happened, of course, but for tax purposes, we pretend it did. And this pretend sale has a really powerful three-step consequence. First, everything is deemed sold at its fair market value. Second, you do the math. You calculate the capital gain, that's the fair market value minus the original cost. And for depreciable property, like a rental building, you also have to calculate any recapture of depreciation. Think of that as the CRA taking back all those tax deductions for wear and tear that were claimed over the years. Then, step 3, all of that resulting income, the taxable capital gain, and the full amount of the recapture gets piled right onto that final tax return. Just imagine, someone who bought a cottage for $50,000 decades ago that's now worth $1 million, that's a $950,000 capital gain and it's all taxed at once. Ouch. So you can see how this leads to a huge potential tax bill. But, and this is a very important but, there's a really powerful exception that's designed to provide relief. It's called the spousal rollover.
The spousal rollover is an absolute cornerstone of estate planning in Canada. Here's how it works. If capital property is transferred to a surviving spouse or a special kind of trust for them, the deemed disposition happens at the original cost, not the fair market value. So, and this is the crucial point, no capital gain is triggered at that moment. The tax is simply deferred. The surviving spouse just inherits the property with its original cost base, and the taxman will eventually get paid when they sell it or, upon their own death. Now, this seems like a complete no-brainer, right? I mean, why would anyone willingly choose to pay tax today when you could put it off until later? But as you're learning in tax, the automatic answer isn't always the best one. An executor can actually choose to elect out of this automatic rollover. So why on earth would they ever do that?
And here's the clever answer. Sometimes the deceased has tax attributes on their final return that are kinda use it or lose it. For example, maybe they had unused capital losses from previous years just sitting there. Well, you could trigger a capital gain by electing out of the rollover and use that gain to soak up those losses. Or maybe they have a huge charitable donation tax credit with nowhere to go. Or, and this is a big one, if the property is a farm or a small business, you might want to trigger a gain to use up that lifetime capital gains deduction. So you see, this turns a simple rule into a really powerful, posthumous tax planning tool.
Okay, so the final return is filed, the taxes are paid. But the story's not over yet. The assets that belong to the deceased are now controlled by an executor, and they're held in what's called an executor's trust. For the first 36 months, this can be a special kind of trust called a graduated rate estate. This is a huge advantage because it lets the estate use graduated tax brackets, just like a person, which can save a ton of tax.
This diagram shows the timeline perfectly. You see that vertical line? Everything up to the date of death goes on the deceased's final return. But the assets don't just sit in a box, right? They might be earning interest or dividends or rent. All of that income, the stuff that's earned after the date of death, belongs to the executor's trust. And that trust will have to file its own tax returns until all the assets are finally handed out to the beneficiaries.
Now, this trust has one more really unique and helpful rule. Let's say in the first year after death, the executor sells an asset and actually takes a loss on it. Normally, that capital loss would just be stuck inside the trust. But there's a special election. An executor can choose to carry that capital loss, or a terminal loss, which is the final loss on depreciable property, from the trust's very first year and carry it back to apply it against gains on the deceased's final return. This can be incredibly valuable, especially if that final return had a massive tax bill from all those deemed dispositions.
If you take just one thing away from our discussion today, let it be this. This whole process isn't just some compliance exercise, it's not just filling out forms. The tax on death can be one of the single largest tax events in a person's entire life, and it all happens at once.
So what's the practical advice you can give? Well, it all comes down to proper planning. And a really common strategy is using life insurance. A tax-free life insurance payout can provide the cash, the liquidity that the estate needs to pay that final tax bill. That way, they aren't forced to sell cherished assets, like the family cottage or the family business, just to write a check to the CRA. And I'll leave you with this question to chew on. As you can probably see now, these rules are complex, for sure, but they are also absolutely filled with planning opportunities. Understanding them doesn't just make you a good tax preparer, it lets you become a strategic advisor, someone who can actually help clients structure their affairs to preserve their legacy. And that's the real value you can bring. Okay, that's all for today. We'll pick this up next class.